top stocks to buy now, cheap. The U.S. stock market is wrapping up the first half of 2024 with robust performance, driven primarily by major technology companies. Investors have been anticipating a market decline, but they advocate staying invested rather than trying to predict market movements. Looking ahead to summer, optimism remains high. July has consistently been the top-performing month for the S&P 500 since 1928. In today's video, we'll explore 4 affordable stocks worth considering for purchase in July. Let's begin with our first stock pick, Equinix, which has a ticker symbol of EQX. Equinix stands out as the largest REIT specializing in data centers. If you've tuned into my weekly live shows, you've likely heard me discuss the REIT sector, particularly its sensitivity to interest rates. Looking ahead, we're hopeful for potential interest rate cuts, which could act as a relief valve for the entire sector. Equinix also benefits from strong growth in cloud computing and AI, offering a promising future for the company. Currently valued at $71 billion in market capitalization, Equinix has seen a 2% decline over the past year and a 6% drop in the first half of 2024. With prices still affected by higher interest rates, now could be an ideal time to consider adding this data center REIT to your portfolio. Now, let's start looking at the dividend. Currently, the company pays an annual dividend of $17.04, which gives a dividend yield of 2.3%. Equinix has shown an impressive 11% growth rate in dividends over the past 5 years, a rarity in the market, and has consistently increased dividends for 8 years straight. Despite significant capital expenditures, particularly in AI growth initiatives, Equinix generates substantial free cash flow. In terms of valuation, analysts predict Equinix AFFO, or adjusted funds from operations, to be $37.70 per share in 2025. This gives them a forward price to AFO ratio of 19.9 times, which compares favorably to their 5-year average of 26.5 times. With expected growth of around 8%, consistent with the past 5 years, we anticipate a similar average multiple. Equinix shares could reach $1,000 per share at this rate, slightly above the current average analyst price target of $944. This suggests a potential upside of over 25% share price and a near 2.5% dividend yield. For investors interested in dividend investing, Equinix offers an enticing opportunity that warrants a closer look. Let's focus on stock number 2, Johnson & Johnson, and the ticker symbol J&J. Johnson & Johnson is a healthcare conglomerate, currently trading near a 52-week low, indicating an attractive valuation. However, legal issues remain a significant concern for the company. With a market capitalization of $351 billion over the past year, J&J has seen its stock decline by 11%, with a further 7% drop in the first half of 2024. In terms of valuation, which we'll delve into shortly, you'll see why looking back in a year or two, you might regret not buying more J&J shares now. Recent analysis has highlighted that J&J maintains a strong competitive position in the healthcare sector, boasting one of the widest moats among its peers. Known for its leadership in pharmaceuticals and a robust medical device segment poised for growth, J&J stands out among leading healthcare companies. However, despite its promising drug pipeline, persistent legal challenges remain a significant cloud over the company. Let's talk about Johnson & Johnson's dividend. J&J is famous for regularly increasing how much money it pays to shareholders yearly. Right now, they pay $4.96 per share each year, which gives investors a 3.4% return on their investment annually. Over the past 5 years, J&J has been boosting this payment by about 6% each year, and they've kept this up for 61 years in a row. For a company to keep raising how much they pay in dividends, they need to make a lot of extra money after covering all their costs. In the last year, Johnson & Johnson made $18.2 billion in additional cash after paying everything they owed, like salaries and bills. Of that, they used $11.7 billion to pay dividends to shareholders. This means they paid around 60% of their extra cash as dividends. Now let's look at how much the company is worth compared to how much money it makes. If you want to buy one share of Johnson & Johnson, you'd pay about 13.8 times what they earn in a year. That's lower than the usual 16 times over the past 5 years. Considering how much free cash they have compared to their stock price, it's about 15.8 times their yearly free cash flow, also lower than the usual 18.7 times. Another way to consider it is how much the company values compared to its earnings before taxes and other expenses. It's around 13.2 times, the lowest since 2016 when typically it's about 16.5 times. Considering all these factors, you might wonder if Johnson & Johnson's legal problems have already affected its stock price. They have, mainly because the company continues to earn more money and expand its business, despite its stock price being near its lowest point in a year. Analysts who specialize in studying stocks also believe there's a strong possibility that the stock could increase by around 20% next year, reaching a target price of $175 per share. Let's discuss stock number 3, Pfizer, and the ticker symbol PFE. If you're a member of our Edge Plus group, where we have over 16,000 subscribers at Stock Investor Edge, you might have noticed Pfizer is gaining attention lately. Many investors see it as a good purchase below $30 per share despite its fluctuations over the past 4 years, especially with the decrease in pandemic-related sales. Now, Pfizer is returning to its normal business operations, which isn't necessarily negative. Pfizer is valued at approximately $158 billion in the stock market. Over the last year, its stock has decreased by 24%. Year to date, it's down by 3%. The stock appears to have found stability around the mid-$20 range. Investors are still buying shares below $30 because Pfizer has a promising pipeline of new drugs. They've also introduced their own version of a popular GLP-1 drug, which is performing well in the market. Regarding dividends, Pfizer stands out with the highest yield compared to other stocks we've discussed. They pay $1.68 per share each year, which gives you an excellent 6.1% return on your investment. Over the last 5 years, Pfizer has increased its dividend by about 4.5% every year, and they've been doing this for 13 years straight. Despite the recent drop in their stock price, this could be a good chance to buy Pfizer at a low price and still get a good return from their dividends. Now, looking at how much the company is worth compared to how much money it makes, Morningstar gives Pfizer a top rating of 5 stars and says it's worth $42 per share, which is much more than what it's selling for now. Pfizer's stock is currently priced at about 12.1 times what it earns each year, which is lower than what it usually is over 5 years. Looking ahead, analysts think Pfizer could grow its earnings by about 16% every year for the next 3 years. This makes Pfizer a good deal because it's selling for less than it might be worth. Analysts also think Pfizer's stock could increase by about 20% over the next year, with an average price target of $33 per share. And now, let's discuss stock number 4 on our list today, which is the Hershey Company, ticker symbol HSY. Hershey's has faced challenges over the past year, mainly due to 2 factors: the popularity of GLP-1 weight loss drugs and soaring cocoa prices reaching record levels. However, these are short-term trends. Despite the use of these weight loss drugs, many people continue to consume junk food and soda, suggesting a limited impact on consumption habits. As for cocoa prices, they have risen due to weather-related issues, which are also short-term. Despite these challenges, Hershey's remains attractive at its current lower valuations. Currently, Hershey's is valued at $37 billion in the market. Over the past year, its stock has dropped nearly 30%, but it's down only 1% year to date. While weather-related issues are temporary, Hershey's can manage them by adjusting prices. In their recent earnings report, Hershey's demonstrated this by achieving nearly 9% revenue growth compared to the previous year. However, higher costs have temporarily impacted their profit margins. Regarding dividends, the Hershey Company, HSY, stands out with a strong dividend yield. They pay an annual dividend of $5.48 per share, which gives investors a solid dividend yield of 3%. Over the past 5 years, Hershey's has increased its dividend by an impressive average of 12% annually, making it the strongest dividend grower on today's list. They've consistently raised dividends for 14 consecutive years, showing a commitment to rewarding shareholders. Hershey's offers a compelling mix of a dependable dividend yield and robust dividend growth, which investors often value. In terms of valuation, Morningstar rates Hershey's stock with 4 stars and believes its fair value is $210 per share, significantly higher than its current price. Hershey's trades at a forward price-to-earnings ratio of 19.1 times, below its 5-year average of 25.5 times. They also trade at a price-to-free cash flow ratio of 14.3 times, again under their 5-year average of 18.2 times. Additionally, their EV enterprise value to EBITDA ratio stands at 13.4 times, the lowest in the past decade, compared to a 5-year average of 19.1 times. These valuation metrics suggest that Hershey's stock is undervalued from multiple perspectives. Analysts also see potential upside, with a 12-month price target of $200 per share, indicating nearly 10% growth from current levels. This reinforces the view that Hershey's presents an attractive investment opportunity based on both its dividend strength and its undervalued stock price.